Trading psychology. What is trading psychology and why should I care? Before we get to that, let's see a couple of short stories. Story 1. A beginner, let's call him Sam. He has learned some strategies via forum or YouTube or some books. He wants to get his hands dirty and see how it goes. He is all excited, logs onto his trading platform, and diligently watches the charts to identify a pattern based on what he has learned. Once he sees an opportunity that seems logical to play, he takes a deep breath and initiates the trade. Let's say the trade works in his favor. Sam is all excited. No matter how skilled or novice you are, you can always land a winning trade. Sam is all pumped up, and over the next few days, he takes some more trades, and he has it all going well. Then one day, he takes a loss on a trade. It does not disappoint him as he has developed some confidence based on past positive outcomes. He just gets into the next trade with a bit more caution. But as there are innumerable variables in the market, it is very likely to hit a rough patch of a series of losses. These losses start to play on his mind. The fear starts to creep in. He starts to doubt himself or the strategy he has learned. The next time the chart pattern aligns with his trading strategy, he may hesitate to take the trade and may look for a few more confirmation signals. By then, the price may have moved too far from the desirable entry. He lets the trade pass only to see it go his way. Then he puts on his learning glasses and sets foot on a quest to find a strategy that can help him beat the market more often. He thinks, maybe I am not using the right technical analysis. Let me learn more about Fibonacci retracements, double bottom reversals, head and shoulder patterns, Bollinger Bands, etc. Or should I do a more advanced strategy? I may not be tracking the right variables. Let me check out on the net. Thus begins a journey in the quest for that strategy and the set of variables that will take his trading to the next level. Does that sound familiar? In fact, I was drifting on this path for quite some time myself before I discovered the importance of trading psychology. Story 2. We have an experienced trader. Let's call her Dossie. She has had a streak of successful trades and has been consistently profitable for a few months now. She is bubbling with confidence and takes up too large a position, contrary to her usual risk appetite. The trade starts to go in her direction, and as the position is huge, small movements start to show big numbers. But moments later the trend reverses and it starts to go the other way. In a usual scenario, she would have exited the trade with stop loss, but since she is overconfident, riding on months of success, she stays in the trade and focuses on the parameters or the candles that tell her that the trade is going to change in her direction in a short while. Her observation of the chart is no longer neutral and is biased towards finding the cues to support the logic of being in that losing trade. After a while, the loss is too large for her to bear anymore, and she takes an exit, albeit at a huge loss. This is a very usual scenario and can play out with the most experienced and skillful traders out there. So, what am I trying to tell you with these stories? As normal human beings, we are governed by our emotions, even when we are not aware of them. We may think at that moment that we are making a decision based on clear facts and charts, but somewhere under the layers lie our emotions that are actually controlling our decision-making. Based on how your last few trades went, you may be hesitant to take a perfectly logical trade if you are Sam from Story 1, or you may take a position even if the chart was not aligned to your regular trading approach, and may even double down on it if you are Dossie from Story 2. We can be both Sam and Dossie at various points in our trading journey. I have usually seen that a lot of books, online courses, either ignore this topic completely or just make a cursory mention. A lot of readers, especially the newbies just entering the game, are all excited about trying the technical indicators, read the charts, and take the trades. I cannot emphasize this enough, but psychology is the most important aspect to be a consistently profitable trader. There are 3 core pillars of trading: the trading strategy, the tools, and psychology. We have already covered the first 2 in previous chapters. Trading psychology deals with the emotions at play when we are trading: fear, greed, hesitation to take a trade, doubting oneself, fear of missing out, and overconfidence are various forms in which our emotions distract us from following a consistent approach. Trading psychology is a very vast topic, but I will try to stay away from the abstract concepts of human psychology that are acting inside our heads as we get into trades, or even when we are not in trades but thinking about it. In this course, I will keep the discussion grounded on the core pillars of trading psychology, why it's a must to take control of, and how can you make that happen with clearly laid out actionable steps. The rabbit hole. When we take a loss or are not able to achieve consistency, we usually do not even think about the psychological aspect, but instead go on to find more technical indicators and new strategies to up the game. I think this mindset is one of the primary factors that differentiate a consistently profitable trader from the mass majority that struggles to be consistent. Across internet forums, Discord channels, Telegram groups, I see a barrage of wannabe traders moving from strategy to strategy, trading tips, stock picks of the day, and so on. The quest to become profitable takes them through a jungle of technical analysis, with endless parameters and chart patterns. Even after having 10 variables listed on the chart, they believe that if they had tracked one more XYZ variable, they might have done better. This is a rabbit hole, and I was lucky to have read about these traps early on. But even then, for almost 6 to 8 months, I found myself going through the same maze of strategy hopping, adding, changing the tracking variables from moving averages to Fibonacci to Camarilla pivots, etc., etc. You may ask, I have to learn strategies. I have to know the variables or parameters to improve. What's wrong with learning more? You are absolutely right. There is no fault in learning more, if done with the right intent. The intent should be to build a system that has a higher probability of win rate, no emotions attached. If the intent is to take revenge on the market after a string of losses, then it's an endless pursuit. You start to develop a fear that the market is after you, and you need to get back at it with more knowledge in order to beat it. Note that the market is agnostic to your position, unless you operate at such a volume that your trades can swing markets in one direction or the other. The thing is that the market makes available almost infinite possibilities to get in the trade, exit, add to your position, take some profits, or reduce exposure. There are no rules here, leading to a number of possibilities. Everyone has the creative freedom to apply whatever strategy or logic in order to interpret the charts. The market does not create any meaning out of the daily proceedings. It's a trader who visualizes it in the form of chart patterns or other signals that convince him or her to take a position. Even in gambling, whether it's roulette or blackjack or any other, there are defined rules that govern your choices. But not so in trading, where there are literally infinite possibilities in which you can play the game. In a gambling game, there is a clear start and a clear end. You actively decide to play the next round by sliding some chips onto the table. But in trading, there is no clear start or end. In fact, it's a continuous stream where you can come in and go at any time or in any way. It is always open, especially with Forex and crypto. You can be in a trade and do nothing. You don't even need to watch it, and it can take every penny away from your account. There are no defined boundaries, unlike on a casino table, where you define your maximum loss by making a definite bet. At this stage, you may be wondering, okay, enough of this lecture, but what do you want me to do? Long story short, the missing piece of the puzzle is not another technical parameter, not another chart pattern, but managing our fear and greed with a disciplined approach. In the next section, we will discuss this approach to overcome these psychological traps. You may ask, are you going to teach mindfulness, spirituality, to control my mind? Keep my emotions in control? Gosh, give me a break. While learning these mindfulness techniques will not hurt, these are not in the scope of this course, and I am not alluding to those skills here. There is a more direct solution to this. We will discuss that in the next few sections. All the strategies and technical indicators that you may already know, or we will learn in further chapters, can only take you so far. In fact, I would say that the tools, technical parameters, and trading setups only contribute 20% of what it takes to be consistently profitable. The next 80%, the bulk, comes from this topic. In the next few sections, I would present to you the concentrated juice of my learnings, losses, emotional pains, excitement, and from my extensive reading on this topic, ranging from trading psychologists to biographies of successful traders and the pitfalls they encountered. I can't emphasize the importance of this topic enough. Especially, a beginner may be restless to get onto the trading platform and do some real stuff. But the learnings in this chapter can make the difference between wandering through the forest paved with endless possibilities, leading to an endless or a very long pursuit of consistency, leading to significant losses, and a guided and an accelerated path to achieving consistent, profitable results. The disciplined approach. It's not what we do once in a while that shapes our lives. It's what we do consistently. Tony Robbins, as mentioned in the book Mastering the Trade by John F. Carter, there are broadly 3 kinds of traders. Those who have a well-defined system, and they follow it each day. Then, there are those who are still developing the system, trying to find the best one ever, the Holy Grail. And then, we have those who never believed in using a system and just trade on instinct or feel, and most likely have lost a lot already in the market. The point here is to highlight the importance of having a system and a disciplined approach. This approach uses a well-defined system that clearly outlines your actions and thus reduces the emotional elements that can come into play when you are watching the charts or based on your last few losses or wins. The second key component of this approach is to trust in the very setup. Once you have back-tested or via testing on a simulator over a large number of trades and the edge is clearly visible, then you just trust the system. Now, if you get a string of losing trades, you do not worry, as you know that over a larger set of trades, you will always be the winner. Just like a casino. Read on to understand this better. Define the risk. Specify the risk you are willing to undertake in each trade before you get in the trade. That means you should define the stop loss and your position size before you initiate the trade. Let's say you intend to take a trade with a fixed dollar risk of $50. If you are taking a long trade on a stock at price $22 and your stop loss is at $20, then the max number of shares you can take is $50 divided by $2, which is 25. Fixed risk per trade divided by gap between entry and stop loss. Define your edge. When you begin your trading journey on a simulator, you can try various strategies and identify the one that resonates with you, and you see a higher success rate. Clearly outline the rules of entry, profit taking, adding to the position, and exit. In the earlier chapters, we discussed various strategies in detail. Feel free to try that or any other approach with a clear edge by backtesting the strategy or using it in your trades on a simulator. Define your edge and stick to it like clockwork. Do not get into trading with real money until you have thoroughly tested the strategy on a simulator. The intent should be to build a playbook, a set of rules that give you an edge, and the rules that work for you as an individual, and not something that you learned about on a forum or blog. You may literally write down the rules and have them in front of you. Be the casino. You might have tried gambling at some point in your life. A lot of us plainly try it with an entertainment objective. Sometimes you might have come out the winner, while other times you lost all the chips. A casino runs a business and is not a non-profit organization. But one wonders that if it has games like roulette or blackjack, that someone can win against the house, how is it that the casino is making money day after day, year after year? The key lies in probability or the odds. In a particular game, you may win against the house, and that is okay. The house is not worried about a few games lost, because in a longer span of time, encompassing hundreds and thousands of games, the house always has an upper edge and will make money. Any game in a casino is designed to give an extra edge, to tilt the odds of winning in favor of the house. That edge may vary from game to game. The essence can be in the design itself or the rules of the game. For example, in an American roulette, let's say we are playing colors, that is red and black. Had the design been fair, we would have 18 divided by 36, that is 50% probability of winning, and the house would also have the same odds. But remember, it's a business and not charity. So, there you have those two little green fellas, numbers 0 and 00. These two blocks tilt the odds in the casino's favor. Now, betting on black or red, your odds of winning are 18 divided by 38, which is 47.37%, while that of the house are 20 divided by 38, which is 52.63%, giving the house an edge of 5.26 percentage points. It may happen that on a Sunday evening, the house loses 10 rounds in a row. But because of this edge, over hundreds and thousands of games, the house always makes money. But why are we talking about gambling and roulette? There is an important lesson here that will help you understand how day trading needs to be played. Whatever technical analysis strategies we discussed in earlier chapters, or the ones you may explore further in your trading journey, are meant to give you an edge, a higher probability of success. What that means is that you may still lose some trades, like games for a casino, but in the longer run, over hundreds and thousands of trades, you will be consistently profitable. But note that your strategy needs to have an edge that is tested, and you diligently follow the steps of that strategy, like the rules of a game in casino. Let's assume you are the casino personified. When someone is placing a bet, you are taking the opposite position by default. If the visitor wins 6 games in a row, would you start panicking? Would you want to change the rules of the game? Absolutely not, because you trust the odds stacked in your favor because of the rules of the game. You know that over a set of hundreds of games, you will always be positive. The edge is real. What is your edge in trading? Your strategy. What is a strategy? A set of rules that define when to enter, exit, add to a position, or take partial profits. If you have a strategy, no matter how simple, that gives you an edge, statistically proven by backtesting or manual forward testing, then do you need to worry about the outcome of a trade? No matter how your last 3 or 4 trades have gone, you play the next one without any fear or overconfidence because you trust the system, the edge. You are the casino. You have no emotions while playing. Be your own police. You are on your own here. A lot of professional traders do so well when they are employed by a trading firm, but the same traders are unsuccessful at day trading for themselves. The trading firm hard codes the rules of participation in the market that the traders have to follow, or else they may face the consequences. When you are on your own, you have to play the police for yourself. Make sure that you stick to the rules in every trade, day on day. I know this sounds boring compared to having the free will to trade by intuition and the adrenaline of getting that winning trade. But if you want to be consistently profitable, trading has to be boring. If trading is exciting for you, then you are most likely gambling, and before long, you may see your assets start to dwindle. In the previous section, we discussed the role of journaling. Maintaining a journal helps you keep track of your mistakes and identify if you did not follow the rules. While it may seem easy to follow the rules, the temptations, FOMO, and greed that emerge from watching the chart patterns can make you do things outside the plan. I have seen many days where I had the plan clearly laid out, but by the time I was done for the day, I had done something entirely different. It could be triggered by something a fellow trader tipped me on, or something that I read on a chat group, or a fear of missing out on an inviting chart pattern that I was sure was about to reverse the next minute. At that moment, you are just tempted to take that step. But over time, if we consistently document our actions, we will be able to reduce such instances and play by our defined rules. We are accountable for our actions in the market. We cannot blame the market, the institutions, or the tools. In the book, The Disciplined Trader, for example, Mark Douglas points out that typical traders often avoid creating principles and rules because they simply do not want to take responsibility for the results of their trading. If you know exactly what you are going to do and under what conditions, then you will have something by which to measure your performance. therefore making yourself accountable to yourself. This is exactly what most traders don't want to do. They would rather keep their relationship with the market somewhat mysterious, which creates a real psychological paradox for traders, because the only way to learn how to trade effectively is to make oneself accountable by creating structure. But with accountability comes responsibility. Emotional disconnect. You need to disconnect your emotions from the outcome of trading by focusing on the process. You can do this by understanding the fact that anything can happen in a trade. Every moment in the trading market is unique, and you need not try to be the predictor of the future. Just like in gambling, the casino has an edge due to the rules of the game. The statistically tested approach that you have is your edge, and you have to keep at that in every trade you take. So, it won't matter if a few trades do not go your way, because you know that in a span of hundreds of trades, if you follow the exact approach outlined in your edge, you will always have an upper hand. These strategies that we develop that give us the edge are based on the fact that market outcomes are not totally random, and there are patterns that repeat themselves over and over again in various time frames. And due to this, our strategy gives us a higher probability of success when executed over a series of trades. If we keep this in mind, we will not have the euphoria of a winning trade, nor feel emotional pain in a losing trade. We are just focused on the rules, and we play the game following the rules every day and in every trade. If we practice this, not only do we control our emotions, triggered by the outcomes, but also get into the driving seat of our trading execution. You are no longer in double mind or hesitant in taking a trade. If it satisfies the rules, you take it, else you let it pass. There is no space for hesitation.